Well, let's go back to your money and your markets right now. Taking a look at the Dow right now. We are up 103 points. If we keep going down this train right now, this positive one, the market is going to hit a major milestone this week. It's going to be the longest running bull market ever. Longer than the dot-com one. Remember that one? This is we learned that President Trump has complained about Fed Chairman Jerome Powell hiking interest rates during a Hamptons fundraiser Friday night. The Federal Reserve has raised rates 5 times since Trump took office. The 2 hikes this year were under Powell. Our own Christina Partsinevelos is here with me on set, and Wall Street Journal chief economics correspondent John Hilzermath. Guys, great to have you both here.
Great to be here.
John, you know the Fed so well. You've covered it for years. It's out of the ordinary for a president to attack publicly, privately, whatever, a Fed chairman's decisions.
Right. We haven't seen that really for the past quarter century. Going back to Lyndon Johnson, Ronald Reagan, George H.W. Bush, there was conflict between the president, the White House, and the Fed. But since Clinton, the policy has been keep your hands off, let the central bank act independently. What President Trump has been doing on Twitter several weeks ago, and then more recently at this Hamptons fundraiser, is start to question what Jay Powell is doing. He's worried that the Fed, by raising short-term interest rates, is going to slow down an economy that's going pretty fast right now. And this frustration, what we're hearing, is really building in the president's eyes.
Okay, that's very interesting that you're hearing that as well. Yeah, Christina, this bull market, 9 years, 5 months, 13 days. Here we go.
Wow, yes.
Look, I mean, the party is still on, but at the same time, does the president really have a point in that rate hikes are going to be a risk?
Yeah, it is the longest, but it's definitely not the strongest expansion that we're seeing so far. However, there could be reasons why he's saying this. You have elections coming up, so he could be speaking to the voters. He could be speaking to the billionaires that were in the Hamptons, and he raised, according to reports, $3 million. Or he could be speaking to the Fed. The Fed is supposed to act independently, so I don't think, and Jay Powell has come out before on NPR. He did his only broadcast interview with them, and he said, I don't care, and I'm paraphrasing.
Yeah, sure, it's okay.
Okay, he didn't actually say it, but paraphrasing that he doesn't care what the president thinks. He has to act independently. But I do believe they are acting much slower than other Feds have in the past. Interest rates are historically low, especially given the unemployment rate. So there is an opportunity for them to go higher. They historically have been higher, and that's when the red flags are going to start to arise, given the high level of corporate debt, given the high level of government debt.
Yeah, and John, I mean, if the president's worried about a risk to the bull market or to the economy, tariffs might be a risk to the economy. Art Laffer, we just had him at the top of the show, very well-respected economist. He said flat out, these tariffs could be incredibly dangerous. They didn't work in the Reagan years. They're not going to work now.
It could be dangerous to the economy, but that's in the president's control. He can't really complain about that. He can do something about it. But, I think what you have with the Fed is a potential whipping boy. And, what they're particularly interested in is not what happens this year. The economy, it looks like we're going to have one of our best years in terms of growth of this expansion. But if you look out to 2019, 2020, his re-election year, the concern is the Fed hikes rates so much and we really get a slower economy. And then the president's question is, who do you blame? And it looks like he's kind of setting the Fed up to blame the Fed if growth doesn't follow through in 2019.
I think you and Christina actually agree on that point. Actually, that's very, very true. And also, Christina, let's talk about a $1 trillion valuation of Apple, a $1 trillion valuation of Amazon. I mean, this is, these companies are benefiting from tax cuts. It's benefiting from, the stronger markets in general.
Yeah. So we're seeing historical levels and these new big peaks that we've never seen in the past. So we can't really use this big, possibly longest bull market as, as let's refer back to history. But I think with a lot of these corporations, the big thing is how are we going to improve productivity and wage growth? And the Fed has brought up full employment. And I think really we should be talking about underemployment, and those are the people that want better quality jobs but are stuck in these part-time jobs or are overqualified. That is an area that actually never seems to come up because it's kind of complicated when you're using terms like that. But I think that given wage growth not climbing higher, inflation isn't going as high as we thought it would. That's the reason why you're seeing the Fed inch its way slower with possibly 1 to 2 more rate hikes this year.
John, her point is actually well taken, but we have talked a lot about the fact that wages don't seem to be keeping up pace and that in other rebounds and other bull runs like we've seen, wages were much higher than they are right now.
Well, and one of the real issues with wages right now is that at this point in time, they're not keeping up with inflation. We have, the wage growth was around 2% for a lot of this expansion. It's crept up to close to 3%. That's not as fast as it's been in past expansions, but it has crept up. What the problem is that inflation is rising even faster right now. And that's where you have to look back at the Fed. The Fed needs to be raising interest rates because it doesn't want the economy to overheat and allow inflation to get too far above its 2% target. So, the president needs to be careful what he wishes for here. If the Fed allows interest rates to stay low and the economy to overheat, worker paychecks are going to look even worse than they do right now because, inflation will outstrip them.
Yeah. John, Christina, you both made incredible points. You agree. That's always good. Nice to have you both here. Thank you very much.